Silver just hit over $100 per ounce for the first time in history this year. Then it crashed nearly 40% in 3 days. Now it's hovering around $78. If you've been watching the silver market lately, you know something unusual is happening. The question is, what's actually driving these wild price swings, and what does it mean for the metal's future? Let's break down what's really going on in the silver market right now. To understand where silver is today, we need to start with some context. Over the past year, silver prices have risen by more than 130%. That's not a typo. The metal that was trading around $35 per ounce in early 2025 shot up to over $120 in January 2026 before pulling back. As of February 20th, 2026, silver is trading at $78.96 per ounce. That's still up significantly from where it started, but the recent volatility has been extreme. What makes this rally different from previous ones is the combination of factors at play. Silver isn't just a precious metal like gold. It's also an industrial metal, with about 60% of annual demand coming from industrial applications. This dual nature means silver responds to both investment sentiment and real-world industrial needs. Right now, both sides of that equation are under pressure in different ways. Let's start with the supply situation because this is foundational to everything else happening in the market. The silver market has been in deficit for 6 consecutive years. That means demand has exceeded supply every single year since 2021. We're not talking about small deficits either. Some years have seen shortfalls of over 200 million ounces. For 2026, the Silver Institute projects another deficit of 67 million ounces. Now, silver does have large above-ground stocks that can buffer these deficits. But when you draw down those stocks year after year, eventually the market gets tight, and that's exactly what happened. By late 2025, the physical silver market in London, which is the global hub for physical silver trading, became very illiquid. There simply wasn't much metal available to move around. This tightness was amplified by something specific to the United States. There were concerns about potential tariffs on silver imports under what's called Section 232. This is a law that allows the U.S. president to investigate whether importing certain materials threatens national security. Silver was included in a critical minerals investigation. To hedge against possible tariffs, traders moved massive amounts of silver from London to New York, where the futures market is based. This created an even tighter physical market in London. Here's why that matters. When a market becomes illiquid, prices can move more violently. Small changes in buying or selling pressure create outsized price reactions. That's part of what fueled silver's surge in late 2025 and early 2026. The tight physical supply created a situation where investment demand could really push prices higher without much resistance. And investment demand did show up in a big way. Global silver investment is forecast to rise by 20% in 2026 to 227 million ounces, a 3-year high. After 3 years of declining investment in Western markets, investors started coming back. The combination of silver's exceptional price performance, ongoing macroeconomic uncertainty, and concerns about Federal Reserve independence all contributed to renewed interest. But here's where things get interesting. While Western investors were buying physical silver like coins and bars, global exchange-traded product holdings actually fell during part of the rally. Silver prices kept climbing even as some major investors were reducing their positions. So who was buying? Much of the demand came from retail investors, particularly in India and China. This retail-driven demand helped push silver from around $80 per ounce up to its peak of $121. Then came the crash. In early February, the nomination of Kevin Warsh as a potential Federal Reserve chair candidate caused the US dollar to strengthen. That was the catalyst. But the real issue was that silver had become overextended. The market was stretched too far, too fast. When that catalyst hit, silver dropped nearly 41% in 3 days. Gold fell about 25% during the same period, which shows you how much more volatile silver is compared to its precious metal cousin. This brings us to one of the key differences between silver and gold. Gold has strong structural support from central bank buying. Since 2022, central banks in emerging markets have been consistently buying gold to diversify their reserves. They don't view silver the same way. There's no similar institutional buying supporting silver's price floor. That makes silver more vulnerable to sharp corrections when investor sentiment shifts. Now let's talk about industrial demand, because this is where the story gets complicated. Industrial applications account for about 650 million ounces of silver demand annually. The largest single industrial use is solar panels. In 2024, the solar industry consumed approximately 200 million ounces of silver. Silver is used in the conductive paste that carries electricity in photovoltaic cells. Here's the problem. Silver prices rising this dramatically creates a serious cost issue for solar panel manufacturers. Historically, silver made up less than 5% of solar panel production costs, often closer to 1.5%. With the price surge, silver now represents over 30% of solar cell costs. That's not sustainable for an industry already dealing with overcapacity and thin margins. The solar industry is responding by accelerating efforts to reduce or eliminate silver from their panels. This process is called thrifting, and it's been happening gradually for years. But the recent price spike has made it urgent. Companies like LONGi Green Energy, China's leading solar panel manufacturer, announced in January that they've made advances in cost-saving technology using copper and other base metals instead of silver. They plan to begin mass production of these new panels between April and June of this year. Copper costs about 0.5% of what silver costs per ton. That's a massive difference. Industry analysts estimate that switching from silver to copper-based metallization could save the solar sector roughly $15 billion per year globally. The challenge is that silver is a better conductor of electricity than copper, so the switch requires technological innovation. But with silver paste now making up 30% of solar cell costs, manufacturers have strong motivation to make those innovations work. This substitution trend is forecast to cause solar-related silver demand to decline in 2026, despite continued growth in solar panel installations. That's a significant shift. Solar demand was a major driver of the structural deficits silver has experienced over the past 6 years. If that demand starts falling due to substitution, it changes the fundamental outlook for the market. Other industrial applications are holding up better. Electric vehicles use between 25 and 50 grams of silver per vehicle, and EV production continues growing. Data centers and artificial intelligence infrastructure also use silver in various components. These sectors benefit from structural growth trends that should support ongoing demand, but they're not large enough to offset major declines in solar demand if substitution accelerates as expected. There's another factor that came into play recently with China. At the start of 2026, China implemented new export controls on silver. Only 44 approved companies are allowed to export silver for the 2026 to 2027 period. This created initial fears of supply disruptions. However, these weren't an outright ban on exports, and the concerns have eased somewhat in recent weeks. China's move appears to be about maintaining control over strategic resources rather than completely cutting off supply. On the supply side of the equation, total global silver supply is forecast to increase by 1.5% in 2026, reaching 1.05 billion ounces. That's a decade high. Mine production should rise by about 1% to 820 million ounces, driven by existing operations and recently commissioned projects. Silver recycling is also expected to jump by 7%, surpassing 200 million ounces for the first time since 2012. The recycling increase makes sense. When silver prices spike this dramatically, people have strong incentive to melt down silverware and jewelry to cash in on the high prices. This scrap supply helps balance the market somewhat, though it's reactive rather than something you can plan around. Here's where we stand today. Silver is trading around $79 per ounce, down from its peak but still substantially higher than where it started this rally. JP Morgan forecasts silver averaging around $81 per ounce for 2026. Bank of America's forecast suggests an average around $56 with potential peaks of $65. Some analysts believe silver could go higher, while others see risks of further downside. The path forward depends on several key factors. First, what happens with the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Back in November, that ratio was about 80-1, meaning 80 ounces of silver equaled 1 ounce of gold. At silver's peak in January, the ratio dropped below 50-1. It's currently around 65-1. If gold continues its structural rally supported by central bank buying, silver tends to follow, though with much more volatility. Second, the substitution question in solar panels will be critical. If manufacturers successfully shift away from silver faster than expected, that removes a major source of demand. If technical challenges slow that transition, solar demand could remain stronger for longer. Third, broader investment sentiment matters enormously. Silver is a smaller market than gold, about 1/10 the size in physical terms. That makes it more sensitive to flows in and out. If macroeconomic uncertainty remains elevated and investors seek alternatives to traditional currencies and bonds, silver benefits. If conditions stabilize and risk appetite returns, silver could face renewed selling pressure. Fourth, tariff policies remain uncertain. The Section 232 investigation concluded without imposing tariffs on silver, but the administration left the door open for future action. If tariffs get implemented down the road, that could revive the physical tightness dynamic that helped fuel the initial rally. There's also the wild card of government stockpiling. While central banks don't buy silver for reserves the way they buy gold, there's growing discussion about government stockpiling critical minerals for industrial security. Silver could potentially get included in those programs, Given its use in strategic technologies, that's speculative at this point, but it's worth watching. For anyone trying to understand silver's trajectory, the key takeaway is that this market is fundamentally different from gold, despite their correlation. Silver's industrial nature means it faces both opportunities and risks that pure monetary metals don't have. The green energy transition and electrification of vehicles and infrastructure create structural demand drivers. But those same industries will work hard to reduce silver consumption when prices spike, because it directly impacts their economics. The current situation is particularly interesting because we're seeing both forces at work simultaneously. Strong investment demand and tight physical markets pushing prices up, while high prices trigger both increased recycling and accelerated substitution efforts that could undermine future demand. Add in silver's inherent volatility, and you have a market that can move dramatically in either direction on relatively modest shifts in sentiment or fundamentals. What's clear is that silver is no longer just riding gold's coattails or serving as a simple inflation hedge. It's become a genuine strategic metal caught between its monetary history and its industrial future. The market is working through profound questions about supply security, industrial substitution, and the real-world costs of the energy transition. Those aren't questions with simple answers, which means volatility is likely to remain a defining feature of this market. So where does that leave us? Silver has had a remarkable run, driven by a combination of fundamental deficits, physical market tightness, tariff uncertainty, and strong investment demand. The subsequent crash showed just how quickly sentiment can shift when a market becomes overextended. Now, with prices still elevated but significantly below their peak, the market is searching for equilibrium. The bulls see continued deficits, growing industrial applications in EVs and technology, and potential for renewed investment flows. The bears worry about solar substitution, rich valuations compared to recent history, and the risk of further corrections if gold weakens or economic conditions shift. Both sides have legitimate points based on current fundamentals. What happens next will depend on which of these forces proves stronger and how quickly the market dynamics evolve. The solar industry's transition away from silver could happen faster than many expect, given the cost pressures they're facing. Or it could encounter technical hurdles that slow progress. Investment demand could remain strong if geopolitical and economic uncertainty persists. Or it could evaporate if we see a return to calmer conditions and stronger confidence in traditional financial assets. One thing seems certain based on recent history: this isn't a market for the faint of heart. The moves in both directions have been substantial, and there's no reason to think that volatility will disappear anytime soon. Whether you see that as opportunity or risk probably depends a lot on your perspective and time horizon. Some investors look at silver's industrial applications and structural deficits and see a metal that's fundamentally undervalued despite recent gains. Others look at the same facts and see a commodity facing serious demand headwinds from substitution while trading at historically rich valuations. The coming months should provide more clarity about which narrative proves more accurate as we see whether solar substitution accelerates, how investment demand evolves, and whether the market can sustain prices at these elevated levels. The silver story in 2026 is ultimately about a market in transition, trying to find its footing between competing forces. Understanding those forces and how they interact is essential for anyone trying to make sense of where prices might go from here. It's a fascinating case study in how markets work when fundamentals, sentiment, and structural changes all collide at once. Whether you're watching as an investor, an industry participant, or just someone curious about commodity markets, silver is definitely a market worth paying attention to right now. If you found this breakdown helpful, I'd love to hear your thoughts. Do you see silver's industrial future as a strength or a vulnerability? Are the structural deficits sustainable, or will substitution change the game? Let me know what you think in the comments below, and if you want to stay informed about developments in commodity markets and economic trends, consider subscribing. I appreciate you watching, and I'll see you in the next one.